Okay, good afternoon, team. Let's start. We have Mahek Jain and Chirayu Mehta from investment banking team who will take us through of business deal. We have got a very good opportunity in this, so we have arranged this webinar. So, Mahek, please start the session.
Yeah, thank you. Good afternoon, everyone. Thanks for your time from your busy schedule. So today we would like to introduce you to this very interesting investment pre-IPO investment opportunity in OfBusiness, which is the largest B2B platform today in the country. Doing almost 25,000 crores of top line, backed by global marquee investors, and yeah, I mean, it's an interesting opportunity for all of us to take to our investors and add value to the portfolio. To begin with, Chirayu, can you kind of share your screen for the presentation?
Yes, I'll do. Ajay ji, you'll have to give me sharing rights. Is my screen visible?
Yes.
Okay, great.
Okay, great. Yeah. So, our business today, the problem what they are solving today is one of a very large problem in a supply chain in SME MSME market, where the smaller retailers or distributors have to kind of place orders with the intermediary, and then intermediary source that product from somewhere, and then they supply it back to the retailers or the consumers, where it takes a long investment time in terms of getting the product to the shelf of a retailer. It could anywhere be a 45 to 60 days timeline. And plus, these intermediaries insist for a advance payment for the raw material what they're sourcing, or they may, charge an exorbitant high cost for offering credit term, which could go as high as 2% per month. So the problem with this is that a lot of these smaller SME MSMEs guys, they are unable to scale up the business because they need a lot of capital to be blocked in the working capital. At the same time, they have to operate at a very thin margin because of this high capital cost which they have to bear. So, off-business founders who come from large consulting firm like McKinsey and private equity firms, and they identified this problem, and they thought of a way to address this problem using technology. And what they did is then they formed a platform and started aggregating demand from the smaller players so that they can, achieve that minimum order quantity. And then they started placing that order directly to the manufacturers. In the process, what they have done is they have brought in efficiencies by reducing the dependency on the intermediaries and placing direct orders to the manufacturers, which obviously, it works in the interest of the manufacturers also, because then they get large MOQs and they can offer, competitive pricing for those MOQs. So off business, then on the one front started aggregating demand from the SME MSMEs for their raw material procurement, and then use that demand to place orders directly with the manufacturers on behalf of these SME MSMEs businesses, uh, and pass on whatever benefit they could by bringing in that efficiency in the supply chain to the end user. Uh, on top of that, because of their platform, they could also offer credit terms which are very competitive, beneficial to this SME, MSME. So instead of paying 2% per month, which they were earlier paying to intermediaries, through off-business platform, off-business is offering them credit term, which is, much lower compared to that. So anywhere between 1.25 to 1.5%. So that's a direct saving of 8 to 9% per annum for these SME, MSME users. So that was a problem, and this is how they solved for this. And because of this, they have started seeing traction in their business right from the inception. So within short time frame of 7 years, they have grown from one category to almost more than 10 categories today, in which they are dealing into different kind of products. uh, Today they are catering to almost 1.6 million, more than 1.6 million MSMEs customer base. And this year, probably they'll be handling a turnover of 25,000 crores, and probably one of the largest, B2B platform today in the country, which is offering end-to-end services. And the beauty of this model is they don't get into any risk on the inventory. So all these orders are back to back. So once they have the demand from the SMEs, they aggregate it and then do the procurement from the manufacturer. So they don't take any inventory risk, any fluctuation in the pricing. So which makes it a very capital efficient model for them. So I'll request, if anybody has any doubts, any clarification, any of the slide, please feel free to drop your message on the chat, which we can either take it in between or we can take it towards the end of the presentation. Today, OFB is largely focusing on these five segments, which forms more than 70% of the total business. So construction, steel, ferrous, non-ferrous metal, chemicals, bitumen, energy, material, and agri commodities. The largest segment would be construction steel for them, where probably they are the leaders in the country in this particular segment. Uh, so while they started this business as a commerce platform where they were aggregating demand and supply, then they also realized that sometimes the OEMs are not able to cater to a particular demand in a particular time frame. So to build in certainty and assurance in the supply chain, they as a strategy they started getting into backward integration themselves and got into their own manufacturing and processing, which enabled them to bring in certainty in the supply chain and also to some extent allow customization for any unique demand which comes in. And this was an important point for them in terms of backward integration and meet the very demand requirement. At the same time, because of the value addition they were able to offer through their own manufacturing capabilities, it also helped them to improve their, let's say, gross margins and the earnings through that. So that worked out very well for them. In last 3 to 4 years, they raised capital, which were largely used for acquiring or building these manufacturing capabilities across the segments. And today, almost more than 25% of the business is contributed by their own value added or the manufacturing capabilities, which has also helped them to improve their PAT margins. From let's say when they started, they were probably operating at 1.5, 2%. Today, they've already reached at 3.5, 4% at such a massive scale, and which is only going to continue to improve as they add further high margin product category as well as expand their manufacturing capabilities. Yeah, should I move on to next slide? Yeah. Off Business also has a sub NBFC as a subsidiary by the name of Oxyzo. Oxyzo today is one of the largest NBFC and SME MSME category, where they are offering loans to small businesses for different purposes. It could be a working capital loan or a capex maintenance or for purchasing any assets, or expanding any factory or warehouse or whatever it is. And the platform is tech driven, so they have their own mechanism in place to ensure that the credit is going to the high quality assets, and there are high returns to be made with the minimal risk and low delinquencies. Uh, and there's a few aspects which Oxizo takes into consideration for any such book building is they largely try to work with uh, customer base who are already banking with a bank in India. So there's a fair amount of let's say records or a consistency in the some history around the the nature of the business. What they also do is they also ensure that a majority of the loans which they are lending are also backed by adequate security. It could be properties, it could be working capital, it could be products, so on and so forth. So today, Oxizo is have its own customer base, while the business is synergistic to off business, and that's why this business was formed. But because of the high quality business profile, Oxizo has been able to attract a lot of SME MSMEs outside of off business platform. So today almost 90% of the business is non off business vendor base. And Oxizo itself has been, has been valued at maybe $1.5 billion in the last funding round as an independent business. Yeah. So as we discussed, our business is the largest B2B platform in the country today, and the only one which has been profitable since its inception. It has been growing at a CAGR of almost 35%. This year, close to 25,000 crore. Next year should be close to 30,000 crores. The part of, I think this year they will be closing at around 700 odd crores. And I mean, it is a consistent growth story for them. Every year they've been increasing the PAT by 250 crores. And the growth is coming both from adding new customer base, adding new categories, adding new SKUs within the same categories. So, for example, they recently got into polymers and apparel. Apparel, for example, they are doing contract manufacturing for some of the global brands, Zara, H&M, where they're making apparels or footwears for them with high margin category product. Similarly, polymers, specialty chemical, which has a huge demand in India, and this is also kind of a high margin product category for them. Uh, yeah, this I think we're broadly. So this is a competitive landscape for our business. So in India today, they are competing in terms of attracting capital from both domestic as well as global investors. So there are a lot of startups have been raising capital. But in terms of the size and the profitability, there are only three startups in India today who are doing a PAT of more than $100 million. Two of them are into fintech, which is Zerodha and Zoho. Uh, so OfBusiness is the only manufacturing and platform play, which is kind of generating PAT at that level within the startup landscape in India. Uh, then there are other companies which are profitable at a PAT level, but not at $100 million kind of a run rate. One of them is Infra.Market, which is the closest competitor as well. Infra.Market is largely focusing on one category of product, which is building material. So they do cement, steel, tiles, that segment. And other companies which are profitable at a PAT level are Lenskart, Boat. And if you see, I mean, all these companies are also in the market to raise pre-IPO and contemplating IPO in next 12 to 18 months. We keep getting this, clarification that why off business has chosen certain categories in what they're operating at. So one of the reason why they chose it that all these categories are extremely large market. If you put together those five, six category, it will almost uh, the target market in SME, MSME space is almost like uh, $300 billion, that too only in India. So off business is playing in the space which is very, very scalable. It's a high market, high TAM, very large TAM, in fact. And today they are doing what, 2.5, $3 billion. So they are not even doing 1% of the TAM what they can do. So there is still, from here also, there is a lot of headroom for this company to grow further. And, I mean, historically, while they have grown at 25-30%, but we expect that given this market they're operating in, they could continue to grow at a similar pace. This is a quick comparison between their peer group. As we discussed, that infrared market is the nearest competitor, which is only into building material. And so their business is kind of directly linked to the real estate activities in India. So because the last few years, the real estate market has been on boom and the construction market has been seeing a upside trend. So the business has done well for them. But, as we are saying, there's a little bit of a stagnancy coming in into the real estate market. So, their growth rate is also tapering down. Then there's Zetwork. Zetwork is a B2B play again, but Zetwork is more into providing solutions for casting and forging manufacturing components. So a Zetwork model is that it's a cloud manufacturing. So whoever wants to get any product manufactured, customized, they can go to Zetwork. Zetwork on the back end, they have tie up with the small manufacturing units where they will get this product manufactured. So it's again, it's an interesting model. They are showing good growth, but it's a long-term investment. They're still looking a way to become profitable. It's a long gestation strategy, so to say. Moglix, on the other hand, is again a B2B play, which is the smallest among the leading platforms in B2B in India. Moglix is into supplying anything other than raw material to B2B platforms. Okay. So other than raw material, if you need anything else in your office or manufacturing unit, it could be your, some components of your machine if it's breakdown, or some paint required for refurbishing, or some wire harnesses, etc. So they provide all these non-raw material supplies to offices and manufacturing unit. So they have their own niche. So all these B2B platforms have been growing rapidly. They have been able to attract capital from marquee investors, both domestic as well as international. And all of them are now, as they nearing profitability, they are also aiming for an IPO very soon. But in terms of size and scale, of business is far, far ahead of any of its competitor, both in terms of scale, in terms of profitability, in terms of market reach, or in terms of their IPO plans. As we discussed earlier, the growth has largely been on account of multiple factors, which is increase in customer base, deeper penetration with the existing customers. They've been able to retain the customers along with the revenue. So the customers have consistently giving them repeat orders. This has been the key reason for their growth. On the profitability side, while they have expanded into profitable categories on the product side, but they've also been working consistently and with a razor sharp focus is to bring down their working capital investment. From starting from earlier, it was almost like 2 months of working capital cycle, which they have been successfully brought down to close to 32, 33 days, which is lowest in the industry in the B2B segment. Some of the other competitors could probably be operating at upwards of 65, 70 days. So they have brought in a lot of this efficiency largely to their razor sharp focus on capital allocation, which of course you help them to improve their ROCE from less than 5% today. It's probably 11 odd percent, again highest in the industry. But with the similar measures and focus and growth plans, within 2 to 3 years, it's likely to increase to almost 20% ROCE. Off business, while the main business is facilitating supply of raw material by directly sourcing from the OEMs or the manufacturer, what they also have done is they have used their tech capabilities and opened their platform to their customers, where the customers can come and I also find some business opportunities. So, for example, there are multiple large companies and government who keeps coming out with tenders, so they consolidate, they kind of curate all these tenders which are open, and they collate it on their platform, and the customer can go through it, choose it based on its net worth, wherewithal, interest area, and they can select those tenders where they want to bid for, and our business kind of facilitate the whole process for them so that they can put a successful bid, and in turn it generates leads and business opportunity for off business. Similarly, they have this tech capabilities where they can enable their customers to explore various financing option through off business, through Oxizo, or from the third party. So there are multiple tech capabilities which they have built, which they kind of plan to facilitate the operations of their customer for sourcing, for managing inventory management, invoicing, analytics, which these small players may not be able to otherwise invest into those capabilities by themselves. So, our business has built those capabilities. They will start offering to their customers. Today, probably they are not charging for it. It's a kind of a freemium model, but as they scale up, as business becomes more mature, they will start a subscription-based revenue on these capabilities, which again, any revenue from this kind of business will directly flow into their profit margins, which again will help them to increase the profitability substantially. The founding team is excellent, with experience of building large businesses. Ashish Mohapatra, he's at the helm of the affairs for off business, and Ruchika Alra, she takes care of the Oxizo business. Then the other founders who come from a professional background and experience of running large, solving large scale problems. Today, they employ almost 1,500 people and work with almost 15,000 contractor staff across their multiple manufacturing locations. And they have been very cautious on their corporate governance as well. So the board comprised of independent directors, who have professionally proven their capabilities. Their auditors have always, since beginning, I think it has always been Deloitte, which is one of the big four. This is again very unusual for a startup in India to work with Big Four auditors for various reasons. But I think the thought process of the management here was to always to kind of prioritize corporate governance over any other growth plans. So today, as we speak, they are backed by some of the largest investors not only in the country but globally. SoftBank from Japan, Tiger Global from US, Norwest, AlphaWave. These are all like massive, large investors who are backing this company, and and they have been kind of doubling down on their investment in every round, whenever the company has raised capital. Last round of capital was raised by them in 21. After that, they have been self-sufficient. They have been growing organically using the cash reserves what they are generating. Today, they are sitting on a liquidity of almost $300 million between our business and Oxizo, which they believe should help them to capture any organic and inorganic growth opportunities which come through. Plus, if you talk to any of the other comparable peer, they will probably talk about runway of 6 months, 12 months, 18 months, and all this stuff. Uh, so this company has been profitable from day one, and with sufficient liquidity, they have the advantage of grabbing any opportunity which come across for the growth. These are financial numbers. Chirag, you want to take them quickly through the financial numbers?
Yeah, sure. So, See, Off Business has done one thing very uniquely and differently, is that unlike some of their peers which focused on one particular industry, Off Business has diversified into multiple product segments and introduced multiple new SKUs, which has helped them scale their revenue from 7,000 odd crores in FY22 to 19,000 crores in FY24, and now almost touching 25,000 crores in FY25. Uh, the simple math behind how they generate their margins is it's an aggregation platform where they purchase from manufacturers and supply it to SMEs by eliminating distributors in the ecosystem and giving SMEs that additional 8 to 10 percentage of cost savings while keeping 6% for themselves. So 6% is their contribution margin, which flows down to PAT at 3%, 3.5% odd. Second thing, what Off Business has done, or to improve their margins, is to get into in-house manufacturing of, let's say, construction steel, so TMT bars. Essentially, they don't run a full-fledged steel business. It eventually is aggregated on their platform, but it helps them do two things. One is controlled supply. In times when there is excess demand and cannot be aggregated from larger players like Tata and JSW, this helps Off Business sort of control supply and make sure that on their platform every demand is fulfilled. Second thing, what they want to do in terms of so basically currently they are just taking construction steel, just taking TMT bars as a case in point. They aggregate 9 lakh tons of uh, TMT in FY24, of which close to 4,20,000, 4,30,000 tons was manufactured by themselves, by their company, which they have acquired in the past. So as Mehak mentioned, one of the key differences between Off Business and its next peer, Infra Market, has been that almost close to 40-45% of the equity which was raised by Off Business, they have committed that capital to acquire companies which could sort of grow their business across product segments, whereas Infra Market has employed that capital mostly in working capital cycles. The prime reason being Infra Market operates at close to 70 days and Off Business operates at 30 days, thereby not requiring a lot of capital to be employed into working cap. So this is what I covered, that they have. So for example, one more example of value add services. So one of it is in-house manufacturing, which helps them improve their margins as opposed to a simple trading or aggregation business, which they're already doing, and they've already close to 30% of their commerce sales comes from in-house manufacturing. The second thing, sort of what they're doing, is trying to add value added services in an aggregation play, which basically means so case in references, they work with Tata Sampanna, which has tur dal. So Tata procures the tur dal, Off Business packages it, brands it, and sends it back to Tata. This is a value add service which Off Business carries out, but it's a high margin business because there's not a lot of capital which goes into. It's a high turn asset turn business, and thereby it's a high return kind of a business. So these two strategies are employed by Off Business. One is in-house manufacturing, and second is value add processes, which will help them improve their margins from current 3.5% to at least 4.5-5% going forward, which will eventually improve their return on capital employed. So these are the targets that Off Business is looking at, which is basically improving EBITDA margins over 5 years and reducing net working capital. So see, improvement in EBITDA margins, as I said, is coming from in-house manufacturing, number one, and number two is expand to global markets wherein they could have a better pricing advantage. That's how they will improve their EBITDA margins. The net working capital, currently, see, they pay 100% advance to manufacturers like JSW and Tata. Just this year, they received a cash discount for aggregating close to 9 lakh tons of steel. So what is happening right now is the volume that OfBusiness is aggregating year over year, the increase in that volume. So FY22, they aggregated close to 6 lakh, which went up to 9 lakh tons in FY24. Manufacturers like JSW and Tata are now willing to give them some credit without impacting the pricing. So to give them a cash discount plus a credit. Cash discount helps them, which directly flows into their margin, and a credit will help them reduce their working capital cycle further from 30 to 20, 25 days, which will lead to them not taking out working capital debt and hence improving their return on capital employed. So two things are happening at once. One is margins are improving because of in-house manufacturing and value-added services. And second is they are requiring less and less money to be blocked in working capital, which will help them sort of go from 11% of return on capital employed right now to 20 odd percent in the next 5 years. So this is the financing business. So as Mehak mentioned, they are extremely careful on whom they lend, and which also shows in their financial metrics of their lending business. Their gross NPA is less than 1%. Their net NPA is less than 0.5%. They have a capital adequacy of 40%, which the RBI requires you to have a capital adequacy of 15%. So there's a 25% headroom for Oxizo, and essentially they have never compromised underwriting for growth, which is also seen in their numbers. Um, uh, and going forward also, I think this is what they are going to do. So initially, for example, when Oxizo started operations, OfBusiness as an entity used to sort of give guarantees or sort of give collaterals for Oxizo to raise debt. Today, there is zero corporate guarantee given by OfBusiness to Oxizo. More important than that, I think Oxizo operates like an independent entity with less than 10% overlap with the OfBusiness platform. So essentially, Oxizo lends to SMEs who eventually transact on the OfBusiness platform. That portion of lending is less than 10%. So it's a completely independent business, having its own set of SME customers and having its own cycle, not related to OfBusiness and OfBusiness's customers. So again, OfBusiness again is a cash generating business. As Mehak mentioned earlier, they have close to 250-300 million of cash, Oxizo and OfBusiness combined, for them to capitalize on opportunities, greenfield and inorganic, going forward. They are also coming out with an IPO wherein close to 75-80% is going to be an offer for sale, and just 20 odd percent will be primary capital getting into the company. The simple reason being they don't need capital, extensive capital right now, given that they have surplus liquidity on their balance sheet. So we are happy to take questions, but in summary, I think I would like to close this business as it's a platform play in B2B raw material procurement, wherein the biggest thing that they do, and what I think other players are sort of ignoring, is that they deal or they trade in absolutely standard products. So even when I say construction steel, OfBusiness only does 8 to 40 construction steel, sourced from only the top players in the country, which sort of makes sure that there is no inventory risk, there is no customer returns, as compared to, let's say, infra market, which is doing construction chemicals, which can have a high customer returns rate. Which is exactly why OfBusiness has been very successful in managing their working capital, because they don't need to maintain any inventory. They have absolutely zero inventory risk. They have absolutely zero pricing risk. The product directly goes from the manufacturer to the SME customer. It's just built to OfBusiness. It is shipped to the customer. So it's a proper plug and play sort of a situation where off business having efficient working capital cycle will have an opportunity to increase their margins, thereby increasing or doubling, almost doubling the return on capital employed. If there are any questions, we can quickly take them one by one.
So what we can do, Chirayu, maybe open the investment note. We'll also take them through the transaction opportunity,
Sure.
and then we can take questions. Sure.
Sure, sure. Maybe Mehak, we can discuss the valuations and the structure.
Hmm. Yeah. So last round of business raised its capital somewhere in December 21, which was raised at a valuation of $5 odd billion. And they have been consistently growing their, the valuation has been consistently increasing, and that particular year itself, over a period of 15 months, the valuation grew from $1.8 billion to $5 odd billion. So even if you were to take an average of that particular time frame, the average multiple for EV by sales was roughly about 2.8x. And I mean, in every round, there were new investors who were coming in, and obviously the existing investors were also doubling down, maintaining their equity stake. So this round, we kind of negotiated with the company and, insisted that, that was the primary round, and this being a secondary, we should be able, I mean, we should have some discounts over it. So we have been able to negotiate about 25% discount on that valuation. So today we are, the equity stakes are available at a valuation of roughly about 4.1, $4.2 billion, which probably work out somewhere about 345 rupees per share. In terms of multiple, it is much lower than what they have raised in past. So from 2.8x, we are now offering this equity at 1.6x revenue multiple. Compared to some of the other companies which are raising capital, like Infrared Market recently raised a pre-IPO round of 1,000 crore. They raised it at roughly about 2.2 times sales. So this is a very attractively priced round and leaves a lot of upside potential for investors who are coming in this round. Uh, okay, now the IPO is being planned in next 12 months, latest by December 25. They've already appointed bankers for it, who are writing the DRHP today. What is the current process is, because they've acquired these entities for manufacturing over a period of last 2, 3 years. So currently they have about 80 odd subsidiaries which are into these manufacturing processes. So it will be practically impossible for them to kind of take the company public without consolidating these entities, smaller businesses into off business. So they have applied to NCLT for merging all these businesses into off business. The application has already been filed. The hearing date has already been announced. So I think in the next couple of months, the order should come in, and post which maybe another 2 months, the merger process should get completed. Immediately after that, they will file their DRHP for the IPO. So we expect that, bare minimum, even if we were to look at very conservative multiple, the IPO could be valued at anywhere between $6 to $7 billion at a very, very conservative estimate, which will potentially generate a 25 to 30% return in a less than 12-month period for investors. But as per lead bankers who are kind of managing the IPO process, they have indicated, a potential IPO valuation of $8 to $10 billion, which could probably price the shares at upwards of 800 to 900 rupees, which can be massive upside for our investors. Having said that, these valuations are independent valuation of the business. There's a hidden value also, which is their equity stake in Oxizo. Oxizo itself can command a valuation of $2 to $3 billion, which can be an incremental upside for our investors who kind of continue to hold the shares. Because at some point of time, I think Oxizo will also see an independent listing. Such plans have been contemplated by a lot of companies. Infrared Market is also, looking at listing their subsidiaries separately, like RDC Concrete, which they acquired. So they have plans to list that entity also separately, which can generate incremental return for their investors by unlocking the value. So there's a lot of potential upside available in the current transaction, and I mean the best part is that the business is built in such a way at such a scale that there is very minimal risk associated with the business itself in terms of the performance or in terms of their revenue growth targets. So it's a very beautifully poised business for IPO, which can give it kind of a short return to our investors. So, I mean, that's what the broad, overview of the business and the transaction. We are happy to take any questions, any clarifications, anything, you want us to dive deeper into. Happy to do that.
So team, if you have any question, please put in chat box.
So, what are the we'll wait for uh, questions to come in. Some of the general clarifications which we have heard from other investors is, what are the risks associated with the business? So in terms of risk, I guess, because of, they're operating in a very price sensitive commodities. So they need to be really, really, cautious in their working capital management. Uh, so that is something which they have to continuously monitor. That is very critical for the profitability of the business. Second, of course, they are operating in a market which is kind of gets impacted with the global policies or global events. Let's say steel, the pricing is determined by how China is behaving. Are they dumping their steel components, or there are some tariffs which are being slapped on them? So it's an environment where the global events would impact in the growth trajectory of the business. But having said that, given the focus of Indian government on Make in India, focus on manufacturing, push to SMEs and MSMEs by offering various incentive schemes. So all these factors will definitely overcome any of the challenges which the business could see in those scenarios. Then the second risk associated with this could be on the timing of the IPO. It largely depends on the NCLT approval. So NCLT is closely monitoring the application for it. So if there's a delay in the approval process, it could delay IPO by a few months. So the current round, what we are looking at is while uh, the investor who is selling, they would be selling equity worth 200 odd million dollars, which is roughly about 1,600 odd crores, out of which we have informed the management that within the PAPL platform, we'll be able to secure demand for 200 to 300 crores of equity. And once we deliver on that, then we'll have allocation for additional equity uh, for them. So it's a substantial round. So we should be able to cater to all our investors who are interested in investing into this business into this opportunity. And in terms of process, it will be CCPS where the payment will be immediate and the CCPS will be transferred to the accounts immediately. So the whole process could be completed within 3 to 5 working days. And yeah.
Mike, you want to possibly mention some of the family offices and investors who've already come in the last couple of months?
Okay, sure. So, this round has seen, immense interest from all the, marquee family offices. So, for example, Asian Paints family office, DLF family office, Poonawalla from, Serum Institute, Shahi Exports, the largest textile exporter in the country, the Times Group, so all the family offices. So, they have these kind of family offices, the large ones who have kind of came into this round. Other than this, there are, these savvy startup founders who have, who come with a Midas, so to say. They have also invested into this round. So Kunal Behel is there. Rohit Bansal is also there. And then Aman Gupta, who's the founder of the Boat, he is also invested into this. So it has all the, I mean, this is a very safe, secure, and high return, investment opportunity. And I think, compared to other investment avenues where our investor would be investing into currently, I think this offers an excellent choice in terms of excellent alternative where they can expect a good amount of return at a minimal risk. So, gentlemen, if there are no further questions for the time being, so we'll. I mean, but maybe later on also, if you have any doubts or clarification, do let us know. We'll be happy to address that. If you want Ajay Chirayo, myself to speak to any of your interested investors, we'll definitely find time out between three of us, and we'll be happy to kind of. Meet them, explain them. If they have any queries, we can do that. Uh, yeah.
So I have a question, like what's the minimum deal size, sir, in this?
Yeah, absolutely. We missed that. Thanks for reminding. So earlier when we started the conversation, that time we were looking at a minimum check size of 30 crores. Now, in last 2 weeks, there has been very important development. The company is now being converted into a public limited company. So now there is no restriction on number of shareholders in a company, which helped us also to, kind of we had a discussion with the management and we convinced them to now they should start looking at a lower investment check also. So now we have got the approval to look at as low as 2 crores per check.
Okay. And what will be the lock-in time in this deal?
So the lock-in time will be, I think after the IPO, I think as per the regulation, it takes about 6 months of lock-in period. So that is the lock-in period, yeah.
Okay. Okay. Thank you. Okay, I think there is no question. So, thank you so much for the insightful details on the deal, and we'll come back to you guys if we have any kind of queries or lead with us.
Absolutely, Ajay. Yeah.
Thank you so much for your time and the webinar.
Yeah. Thank you, everyone. Thank you for participating in it. Yeah.
Thank you, everybody.